Hey guys, this is RG and I'm back today with another video. Today I wanted to go over the 3 things that happen to stocks during a recession. As I'm sure you're all aware, we are currently going through a very turbulent time in the stock market. Stock market values are dropping, revenues are being impacted, and much of the country is under a stay-at-home order. So today I wanted to provide you with 3 things that happen to stocks during a recession. Number 1, stocks drop in value, but so do earnings. For the last few weeks, stocks have rebounded after dropping by approximately 34% in March. As you can see by this chart, stocks are back up approximately 24% from the lows in March. Economic recessions pose multiple problems for companies. For one, their timing can oftentimes be difficult to predict. It's also difficult to gauge their severity, and their impact on revenues can actually vary. Recessions are typically hard to predict and gauge because the characteristics surrounding them can vary widely. So far, unemployment seems to be the biggest threat to our service-based economy, with much of the workforce being required to stay at home as a response to the global sickness. Businesses are closing their doors, people are being laid off or furloughed, and the government is stepping in to fill the void by using an unprecedented amount of easy monetary policy in an attempt to keep the economy running. The Fed has stepped in and injected liquidity and stimulus to basically keep the lights on. With all this in mind, there's no telling how significantly earnings will be impacted. So I wanted to go over a really interesting report that discusses future earnings that will hopefully provide you with additional insight as to where the market is headed as far as earnings are concerned. Now, I recently found a report that sheds light on certain stock metrics that was released on April 9th by FactSet.com. They are estimating a 10% decline in earnings for the first quarter of 2020, which would make this the largest year-over-year decline in earnings since the Great Recession in 2009. They also indicated that all 11 sectors have lower growth rates today compared to their December 31st, 2009 estimates due to downward revisions to EPS estimates. For the first quarter of 2020, 72 S&P 500 companies have issued negative EPS guidance. Now, I think it's still way too early to know exactly what impacts most companies will have as far as earnings are concerned, but I am predicting that they will be severely impacted. They are estimating a decline of 20% in earnings for the second quarter, an 8.5% decline in the third quarter, and less than a 1% decline in the fourth quarter, which doesn't sound too bad considering everything that is happening globally with the global sickness that is impacting virtually every country. Now, if the global sickness returns in the fall or winter, I'm sure that earnings would be further impacted. Something to keep in mind is that not all companies or sectors have been impacted equally. Recently, the energy sector has been struggling due to the oil surplus. The airline and cruise line sectors also have been severely affected. There is a little bit of good news. Industry analysts are predicting that the S&P 500 will close above 3,200 within the next 12 months. So obviously there is a bullish sentiment. Now, at this point in time, the waters are too murky to know exactly how severely earnings will be impacted. However, one thing is for sure, earnings will be decreasing and certain sectors and companies will be impacted more severely than others, which makes it critical that you do your own research and due diligence before making any decisions. Number 2, dividends are cut or suspended. Now, recently I've come across various sources indicating the dividends are getting suspended. This means that a lot of companies must be under serious financial stress, since dividends are one of the 2 ways which companies can return capital to stockholders. As companies struggle to deal with decreasing revenues and earnings, dividends will be reduced as well as suspended. Companies that have already suspended their dividends include companies like Boeing, Marriott, Ford, Delta, Darden Restaurants, which is a parent company of Olive Garden, BJ's Restaurants, Macy's, Nordstrom's, Dave & Buster's, Bed Bath & Beyond, amongst others. And this list doesn't even include any companies which have reduced their dividends or suspended stock buybacks. So if you are a dividend investor, make sure that you do your research before buying any stock. Stocks that have relatively safe dividends, however, include companies like Johnson & Johnson, Microsoft, Apple, Merck, Procter & Gamble, and 3M. There are also other companies which continue to pay a dividend, but keep in mind that this can change as economic conditions worsen. I just saw an interview with the Chevron CEO where he stated that Chevron would suspend its stock buybacks in an attempt to preserve cash. However, he did confirm that they would continue to pay a dividend. Nevertheless, you have to believe that this can change at any point in time, especially when considering the fact that there is an oil surplus, which has led to plummeting oil prices. Number 3, bankruptcies. Now this one is an investor's worst nightmare, simply because a bankruptcy can completely destroy whatever is left of a company's equity and destroy stock values. One of the main reasons I started this channel is because I have been witnessing many young investors investing into very risky companies, thinking that really low stock values will lead to unprecedented returns. That can definitely happen, and I'm not trying to discourage you, but for those of you that remember the great financial crisis, I am sure that you remember the wave of corporate bankruptcies that followed after stocks dropped. What many young investors may not remember is that investing in ultra risky companies can be incredibly unpredictable due to the possibility of bankruptcy. Back during the great financial crisis of 2008-2009, several companies went through some form of bankruptcy or restructuring. Companies such as Lehman Brothers, Washington Mutual, General Motors, Citigroup, Chrysler, and Charter Communications, amongst others, all went through some form of bankruptcy. Nowadays, many investors never talk about these bankruptcies and how they wiped out several stockholders who were left with nothing. In fact, I found a 2013 article that discussed GM's bailout and how it impacted investors. The article stated that holding on to companies going through a restructuring or a bankruptcy is rarely a good idea. One of the many failures of the Great Recession was General Motors. Unbelievably, GM went from one of the most important companies in the nation to basically a penny stock. GM received a government bailout, but its shareholders didn't. In GM's case, common stockholders in the old General Motors were essentially wiped out. Investors must learn from the situation and remember that holding on to a failing company stock is not a good idea, and sometimes it's better to sell a stock in order to avoid a more catastrophic loss. In summary, please remember that when stock prices decline during a recession, this offers incredible buying opportunities. However, investors need to do their research since earnings usually decline, which can compromise the vitality of a company. As an investor, you don't want to catch a falling knife that could reduce your portfolio returns. Also, when earnings decline, one of the first things that companies do is suspend or reduce dividends. Dividend investing has never been more popular. I love all of the content that people post on social forums and YouTube where they share their dividend portfolios and returns. With this in mind, I just want to remind you that risky companies with poor balance sheets and high dividend payout ratios are some of the first to reduce or get rid of dividends. Last but not least, it's important that you remember that low stock prices don't automatically mean that a stock is a good value. History has shown us that during recessions, many companies are oftentimes forced into bankruptcy, restructurings, or government bailouts. These remedies can save a company, but oftentimes they don't save stockholders. Companies attempting to secure bailouts will have to deal with conditions and terms that may not be favorable for stockholders. So be aware of this, especially since favorable terms may not be politically palatable. Please keep in mind that I am not a professional advisor or an expert. These are just my thoughts regarding the precarious economic times we find ourselves in, and I wanted to share with you all. I am actually thinking of developing a risk portfolio made up of some of the riskiest companies in the market today. I would like to do this in order to chronicle the portfolio on this channel and document its performance as a case study. If you all are interested in seeing this, please let me know. I think it would be a fun series to chronicle on the channel. That is going to do it for this one. If you guys enjoyed the video, please feel free to hit the like button and subscribe. I'll see you guys on the next one.